Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. The US earnings season is well underway now, and I couldn't be happier. We have the biggest names in global business sharing not just their latest quarterly results, but also their outlook for the year and the way in which their businesses are responding to the world around them. Access to full transcripts is a wonderful feature of the US reporting season, allowing us to really dig into the drivers of performance. What makes this earnings season particularly interesting is that the latest quarter featured tons of tariff uncertainty. The first quarter numbers were hardly impacted by any of this, as things only really kicked off at the beginning of April with tariffs. That's when there was a flash crash in the markets based on tariffs that felt like they should have really just been an April Fool's joke. And because so many of those tariffs turned out to be pretty close to a joke, that crash ended up being an incredible opportunity to buy the dip. It's hard to know what to focus on this week from earnings season, as there really is so much. The US banks, for example, got earnings season off to a great start, with strong trading revenue as one would expect during a time of market volatility. The biggest surprise for me was the strength in investment banking advisory fees. In a time of uncertainty, my experience with South African corporates is that they tend to sit on their hands. But over in the US, it seems as though corporates just push through anyway, with that overall sense of optimism that is a feature of American business DNA. This optimism is exactly why JP Morgan and Goldman Sachs remain core portfolio positions for me. But when it comes to megatrends, there are two that keep coming up at the moment, one of which isn't even related to the US earnings season in particular. The first is, of course, AI and the seemingly insatiable demand for chips. Interestingly, there are companies that aren't actually based in the US, yet they have ADRs listed in America, that's American Depository Receipts, basically just a way to buy the stock in the US, and hence they attract a lot of attention there. I'm going to cover TSMC and ASML specifically. And the second trend is European defense stocks, one of the few areas in Europe that is really showing growth at the moment. You might recognize Saab as a manufacturer of unusual cars that were once available in South Africa. But the real story is one of fighter jets and defense technology, which is why that share price has more than doubled year to date. This means that Saab has outperformed the AI stocks in 2025. But Saab is just one part of a much broader story. But let's dig in with the AI names first. We have two conflicting growth stories in the world of chips right now. I'll start with Taiwan Semiconductor Company, or TSMC, literally one of the most important companies in the world. It's why Taiwan is such a hot topic from a geopolitical perspective, with concerns around what China may or may not do with Taiwan. My view on this is simple. If the worst happens and global superpowers like the US and China go to war, then quite honestly, the least of your problems will be your share portfolio. Hence, black swan events, extreme black swan events like World War III, aren't worth spending much time thinking about in an investment context. Instead, we can just focus on the numbers and think about that, like a 38.6% increase in revenue at TSMC on a year-on-year basis in the second quarter, good enough for a 60.7% jump in earnings per share. And get this, compared to the first quarter, revenue was up 11.3%. In other words, the sequential quarterly growth rate is higher than many mature companies can manage in 12 months. TSMC is very good at generating profits, with a gross margin of 58.6% and net profit margin of 42.7%. Those are astonishingly high. But the downside is that free cash flow margins aren't nearly that high, as the capex bill is enormous. These days, roughly half of their cash from operations in any given period is reinvested in capex. Chip fabrication is a very, very expensive business. In terms of outlook, TSMC expects a sequential increase in revenue of 9% in the next quarter, or 38% year on year. They do expect to see margin dilution though, so this is interesting, as the fabs they've built in places like Arizona can't run at the same ridiculous margins as the ones in the East. From a supply chain risk perspective, though, there was little doubt that tech companies in the West would want to see more manufacturing on US soil, though. So this is simply a feature of the world we live in. The US stock code is TSM, and the share price is up 21.8% year to date. The 5-year compound annual growth rate, or CAGR, that's 24.4%. That is quite a story. We now get to ASML, the European company with the lithography technology that powers global chip manufacturing. This is literally the shovel in the gold rush when it comes to chips, so you would expect them to be telling an incredible growth story, right? Wrong. As one of Europe's 2 large tech companies, with SAP being the other one, ASML should be the poster child for Europe's ability to get a slice of the action in a world looking for opportunities beyond the US. And yet, if you look at sales in the second quarter, they were slightly down on the first quarter. And this is despite them coming in towards the top end of guidance. Now, the thing to remember is that sales of manufacturing machinery will be lumpy. These might be the shovels, but they are the biggest and the most expensive shovels imaginable. So looking at quarterly results can be misleading. Instead, it's better to look at the full year expectations, with ASML expecting their revenue to be up around 15%. That's okay, I guess. Not exactly the growth rates we're seeing at TSMC, is it? It gets worse though as you look out to 2026, with ASML's management saying that they cannot confirm that they will grow at all in that year. This came as quite a shock to the market, driving a nasty sell-off in the share price. Year to date, ASML is now up just 6.4% on the US market, and over 12 months it's down around 20%, while TSMC is up 43%. Even where Europe actually has a horse in the AI race, it seems to be a rather lame horse in comparison. Is this just a case of European conservatism coming through in that 2026 guidance, hurting the ASML share price in the process? Or has the geopolitical climate done enough damage to give chip manufacturers a reason to hit the pause button on their manufacturing capacity? Something is not adding up in this space, that's for sure. We now move on to the European defense theme, where Saab is one of many winners. Now, in many cases, stock picking is a really important part of the investing process, but sometimes you can literally just throw darts at a theme, and European defense stocks are proof of that. Better than throwing darts, you can just find yourself a suitable ETF, like the Select Stocks Europe Aerospace and Defense ETF, which trades on the US market with the ticker EUAD. It's up 77% year to date, which is a rather delightful return. The driving force behind this is, of course, Trump and the clear message that he sent to European governments that they need to press the big green button on defense spending. NATO countries have been relying on the US for too long, and those days are now behind us. The obvious winner is European companies that manufacture defense technologies ranging from fighter jets through to tanks and support systems. And you'll find those companies in that ETF. Saab is a perfect example, with sales up 30% year on year and delivering the group's best ever second quarter. The order backlog is growing as well, something that investors love to see, of course. And perhaps most interestingly, even though Saab is synonymous with fighter jets, the growth is coming from various areas of the business, including surveillance and ground combat. The bigger question around Europe is whether we will see some excitement beyond just these defense stocks, especially as these are companies that many investors just won't buy for ethical reasons. In last week's Supernatural Stocks, I covered Jamie Dimon's recent comments aimed at Europe and the relative lack of opportunities in the region once you move beyond just one or two key sectors. As a final comment on this European theme, I organized a dinner this week where one of the guests was a European business advisor who works with numerous startups in the region. She happened to be in Cape Town this week, and she confirmed that there's been a serious kick up the you-know-what in the region, with far more willingness to actually get deals done. Perhaps the winds of change are blowing, but those winds will take a long time to lead to a meaningful change in the listed landscape in Europe. And with ASML as the largest constituent of the Euro Stoxx 50 ETF that I talked about last week, investors will want to see far more optimism from that company about growth. In the meantime, it looks like growth in Europe is coming from their defense stocks and not really anywhere else. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in Supernatural Stocks should be taken as advice.